If you have a bank account in Australia right now, three things are happening to your money simultaneously. The first one your bank will mention if you ask the right question. The second one is buried in a terms and conditions update you were sent 6 months ago and never read. And the third one, the one that should be on the front page of every newspaper in this country, is the one your bank is legally permitted to action before you ever find out it happened. In the next 20 minutes, I'm going to show you the exact dollar threshold that triggers automatic reporting of your transactions to a federal intelligence unit. The second threshold that has no flaw at all and that most Australians have never heard of. The 7 specific behaviors that put your account under surveillance right now. And the 5 moves that financially literate Australians are making today to keep their money working, accessible, and outside the monitoring zone. If you keep your savings in a standard Australian bank account, watch this video to the end. Because the number I'm about to give you is not the number your bank tells you to watch. It is the number your bank uses to watch you. My name is Mitchell Levi. I have spent years tracking the intersection of Australian banking regulation, financial intelligence law, and the retirement savings of ordinary Australians. What you are about to learn is the same information I walk people through before they make the financial decisions that cannot be undone. There is no version of this conversation your bank will ever start with you. Your bank profits when your money sits idle and uninformed, so they have zero incentive to begin it. Before I get into the numbers, I need to tell you about Gary. Gary is 67 years old. He spent 31 years working for the same civil engineering firm in Toowoomba, same employer, same superannuation fund, same branch of the same bank he joined in 1989 when he was 24 years old and had just landed his first proper job. Gary retired in 2023. He has a modest super balance. He owns his home outright. He has a savings account at his bank with a balance of $114,000, money he accumulated carefully over 3 decades by living within his means, avoiding credit card debt, and putting a fixed amount aside every single fortnight without fail. Gary is not wealthy. Gary is careful. Last year, Gary decided to help his son purchase a commercial vehicle for a small business he was starting. The purchase price was $41,000. The seller wanted cash. Gary had the money. He had been at his bank for 34 years. He walked in on a Wednesday morning, presented his identification, and asked for a bank check made out to the seller. The teller looked at the screen, asked Gary to take a seat. A branch manager appeared. Gary was taken to a small office at the back of the branch. He was asked a series of questions. Why did he need this amount? Who was it going to? Had anyone contacted him recently about an investment opportunity? Had he met anyone new online? Had he been approached by anyone asking him to move money on their behalf? Gary is a 67-year-old retired civil engineer from Toowoomba who wanted to help his son buy a truck. He answered every question clearly and calmly. He received his bank check. He went home. 3 weeks later, he received a correspondence from his bank informing him that his transaction had been reported to AUSTRAC, the Australian Transaction Reports and Analysis Centre, Australia's financial intelligence unit. The report was filed under the Anti-Money Laundering and Counter-Terrorism Financing Act 2006. It is now sitting in a federal database. It will be cross-referenced against Gary's future transactions for years. Gary has never committed a financial crime. Gary has never been charged with anything. Gary has never done anything other than save carefully and try to help his son. That is exactly what the current system is doing to ordinary Australians every single day. And it starts with one simple fact. Gary kept too much money in one account and moved too much of it in a single transaction. That is the only thing he did. And that is what I'm going to teach you to understand today and what to do about it. Let us start with the rule that every Australian has heard something about and almost nobody actually understands precisely. Under the Anti-Money Laundering and Counter-Terrorism Financing Act 2006, commonly called the AML-CTF Act, any business that provides what the legislation calls a designated service is required to submit a threshold transaction report to AUSTRAC. Whenever they handle physical currency of $10,000 or more in a single transaction. Let me be specific about what that means in practice. If you walk into a bank, a currency exchange, a car dealership, a real estate agency, a solicitor's office, or any of the hundreds of other reporting entities covered under the Act, and you hand over $10,000 or more in physical cash, that transaction is reported to AUSTRAC within 10 business days. Automatically, without your input, without your consent, without any suspicion being required. The report includes your full legal name, your date of birth, your address, the amount of the transaction, the type of transaction, the time it occurred, and the name of the entity that filed it. That report goes into AUSTRAC's financial intelligence database. That database is shared with the Australian Federal Police, the Australian Criminal Intelligence Commission, the Australian Taxation Office, the Australian Securities and Investments Commission, and numerous state and territory law enforcement agencies. Once your name is in that database against a threshold transaction report, it stays there. Every future financial transaction you make is cross-referenced against your history. Patterns that appear unusual are scored. Scores above a threshold are reviewed by a human compliance officer. That is the system. Now here is the part where most Australians make the mistake that costs them the most. They think that if they stay under $10,000, they are safe. They are not. Because the $10,000 rule is not the rule you actually need to understand. The rule you need to understand is called the suspicious matter report, and it has no dollar threshold at all. A suspicious matter report can be filed on a transaction of any amount, $10, $500, $3,000, any amount whatsoever. There is no flaw. The decision to file is made entirely by the reporting entity's internal compliance team, based on whether your transaction fits a pattern their systems have flagged as potentially suspicious. Under the AML-CTF Act, reporting entities are required to submit a suspicious matter report to AUSTRAC within 24 hours if they form a suspicion that a transaction may be related to a serious offense, tax evasion, or proceeds of crime. For other suspicions, the window is 3 business days. The report goes into the exact same AUSTRAC database as the threshold transaction report. You will not be told it was filed. You have no legal right to know. And here is the part that should genuinely stop you in your tracks. If a bank employee tells you that a suspicious matter report has been filed or is about to be filed on your account, that employee has committed a criminal offense under Section 123 of the AML-CTF Act. It is called tipping off. The penalty is up to 2 years imprisonment. That is why your bank cannot warn you. That is why the branch manager, who was perfectly pleasant and answered all your questions professionally and sent you home with your bank check, cannot pick up the phone and say, "Just so you know, we had to file a report on that." They cannot say it. The law prevents them, and the bank's compliance team has every incentive to file and no incentive to hold back. A bank that files a suspicious matter report incorrectly faces 0 penalty. A bank that fails to file one when it should have faces regulatory action, significant fines, and potential loss of their AML-CTF license. File first, ask questions never. That is the entire incentive structure your bank operates inside. Now I want to give you the 7 specific behaviors that AUSTRAC's reporting guidelines and bank compliance software are trained to identify. I want you to listen to these carefully because most Australians who consider themselves financially responsible have exhibited at least 3 of them in the last 12 months without any awareness that they were doing so. Behavior 1, a transaction that breaks your historical pattern. Bank compliance systems do not just look at what you do, they look at what you do relative to what you have always done. If your account has averaged $2,000 in monthly withdrawals for 5 years and you suddenly withdraw $12,000 to buy a caravan or help a family member, that deviation is flagged. The system does not care why. It flags the difference between your history and your current behavior. A retiree who has lived on a predictable pension deposit and modest withdrawal pattern for 3 years and then requests a large one-off withdrawal will be flagged even if the amount is well below $10,000. The flag is not about the amount. It is about the break in the pattern. Behavior 2. Multiple transactions that when combined would have crossed the $10,000 threshold. 2 withdrawals of $4,500 on consecutive days. 3 deposits of $3,000 over a week. 4 transfers of $2,500 across a fortnight. These patterns are what Australian law calls structuring. And under Section 142 of the AML-CTF Act, deliberately arranging transactions to avoid the $10,000 reporting threshold is a criminal offense carrying up to 10 years imprisonment. I want to stop here because this is the behavior that has caught the most innocent Australians, and I want you to understand it completely. In 2019, the Australian Federal Police and AUSTRAC prosecuted a case involving a small business owner in Victoria who had made regular deposits slightly below $10,000 for operational reasons. That had nothing to do with avoiding reporting. The business owner had no idea the structuring provision existed. The investigation took 2 years. The legal costs were substantial. The deposits were entirely legitimate business income. The structuring law does not require intent to deceive. The pattern itself is sufficient to trigger investigation. Ignorance of the law provides no protection. Behavior 3. A wire transfer or large electronic payment to an account your bank has not seen you interact with before. The first transfer to any new payee above a certain amount is the single highest risk transaction type in bank compliance software. It is the most common mechanism used in fraud, scam operations, and money movement. Your bank's algorithm cannot distinguish between you paying a legitimate solicitor for the first time and a scammer moving funds out of an account they have compromised. So it flags both. Behavior 4. Round number transactions just below the reporting threshold. A cash withdrawal of exactly $9,000. A deposit of exactly $8,500. A transfer of exactly $9,500. Bank compliance software is specifically trained to identify round numbers in the vicinity of $10,000 because they are the signature of someone who knows about the reporting threshold and is trying to avoid it. The irony is devastating. The act of trying to be careful, the act of thinking you are being smart, is precisely what the algorithm is looking for. Behavior 5. Account activity that does not match your known income profile. AUSTRAC's guidelines require reporting entities to understand their customers, a process called Know Your Customer. If your bank's records show you are a retired pensioner receiving a fortnightly Centrelink payment and a super pension, and you suddenly receive a large cash deposit from a private individual, that deposit will be reviewed regardless of its legitimacy. Sold a car privately, received an inheritance distribution, got repaid a family loan, received proceeds from a deceased estate. All of these are legitimate. All of them will be reviewed if they arrive in your account without a prior paper trail explaining them. The protection is documentation. Before a large deposit arrives, call your bank. Tell them what is coming. Tell them the source. Ask them to note it in your account file. When the compliance software flags the deposit, and it will, the reviewer sees your proactive explanation and the suspicious matter report goes unfiled. Behavior 6. Third-party cash deposits into your account. If your adult child, your neighbor, or anyone other than you walks into your branch and deposits cash into your account, that transaction is logged as a third-party deposit and reviewed at a lower threshold than a deposit you make yourself. Third-party cash deposits above a few $1,000s are reviewed almost universally across Australian major banks. Behavior 7. Transactions connected to flagged geographic regions, industries, or merchant categories. AUSTRAC maintains risk classifications for transaction types, industries, and geographic connections. Transfers to certain countries, payments to certain business categories, receipts from entities in flagged jurisdictions. You do not need to be doing anything wrong. You just need to be transacting with something on the risk list. The flag is based on association, not intent. Now stack those 7 behaviors against the $10,000 threshold rule and the no threshold suspicious matter report. And you can see why the answer for any financially aware Australian is not to try to game the monitoring system. The answer is to understand it well enough to operate transparently within it, and to stop keeping more money in the watched environment than your actual needs require. Here is something your bank will never calculate for you. In 2026, the average interest rate on a standard Australian bank transaction account is approximately 0.5% per annum. On a savings account, it is marginally better, somewhere between 1 and 2% depending on the institution and whether you meet their bonus interest conditions. The current inflation rate in Australia is running at approximately 3.5%. Which means every dollar you leave in a standard Australian bank account is losing purchasing power at a rate of approximately 1.5 to 3% per year. The dollars are still there. They buy less. You did nothing. You lost anyway. Now consider what your bank does with those deposits. The major Australian banks are currently lending at home loan rates between 6 and 7%. On a standard term deposit, your bank might pay you 4% if you lock the money away. The spread between what they pay you and what they charge borrowers, that spread is the bank's margin. On $100 billion of retail deposits, that margin generates billions of dollars annually. Your money, their profit. Your inflation loss. The Commonwealth Bank of Australia reported a cash net profit of approximately $10 billion in the 2024 financial year. Westpac, ANZ, and NAB posted comparable figures. These are not accusations. These are published results. The business model of holding your money at minimal interest while lending it at substantially higher rates is not a secret. It is the disclosed strategy of every major Australian bank. The reason your bank cannot answer your questions about where your money goes or why the interest rate on your savings is a fraction of the rate on your neighbor's mortgage is not because your banker is incompetent. Explaining it clearly would not help that model. And beyond the interest rate reality, there is the concentration risk that most Australians have never been told about. Under the Australian Government Financial Claims Scheme, deposits at authorised deposit-taking institutions are guaranteed by the Australian Government up to $250,000 per account holder per institution. Per institution, not per account. Per institution. If you have $300,000 across 2 savings accounts at the same bank, $250,000 of that is guaranteed. $50,000 is not. If that institution were to fail, and Australian bank failures are historically rare but not impossible, $50,000 of your money could be at risk. The answer is not to distrust Australian banks. The answer is to understand the protection structure and position your money within it deliberately rather than accidentally. If your total savings across cash and term deposits exceeds $250,000, move the excess to a second institution. Not a second account at the same bank, a second institution. The protection is per institution, not per account. This applies to couples as well. The $250,000 guarantee applies per account holder, which means a couple can hold $500,000 across joint and individual accounts at a single institution with full coverage if the accounts are structured correctly. Move 3. Shift savings above your 3 to 6 month emergency buffer into higher yielding guaranteed instruments. The major Australian banks are not the only authorised deposit-taking institutions. Smaller Australian banks and credit unions currently offer term deposit rates between 4 and 4.5% on 12-month terms, fully guaranteed under the Financial Claims Scheme. The application takes 30 minutes online. The money moves via bank transfer. The interest rate difference on $100,000 between a standard savings account at a major bank and a term deposit at a smaller authorised institution is approximately $2,000 to $3,000 per year. On $200,000, it is $4,000 to $6,000 every year. for doing nothing except moving money between two accounts both guaranteed by the Australian government. Move 4. Consider Commonwealth government securities for amounts above the deposit guarantee threshold. Australian government bonds issued by the Australian Office of Financial Management are debt instruments issued by the Commonwealth Government of Australia. They are not covered by the Financial Claims Scheme because they do not need to be. Current yields on short-term Australian government securities are running between 4 and 4.5%. They can be purchased through the ASX or through a brokerage account. They are not bank deposits and therefore not subject to bank compliance monitoring in the same way. For Australians with savings above the deposit guarantee threshold, government bonds offer an alternative that carries the highest possible credit quality available in Australian dollars. Move 5. Maintain a documented cash flow record for any transaction above $5,000. This is the simplest and most consistently underused protection available to any Australian. A personal transaction log. The date, the amount, the source or destination, the purpose, kept contemporaneously, meaning at the time, not reconstructed later. A note on your phone. A spreadsheet updated weekly. A notebook kept beside your banking folder. When AUSTRAC or a bank compliance team reviews a flagged transaction, the difference between a clear explanation and a suspicious pattern is almost always documentation. People who get caught in AUSTRAC investigations are not usually people who did something wrong. They are people who did something right and cannot prove it because they kept no record. The documentation costs nothing. The absence of it, when you need it, costs everything. Let me now tell you what Gary did after he received that letter from his bank. He rang a financial advisor who understood the AUSTRAC framework. Not a generalist, someone who works specifically with retirees managing larger cash holdings. The advisor spent 2 hours with Gary, going through his account history, his upcoming financial plans, and the specific transactions that had generated the report. What the advisor found was not wrongdoing. It was a perfectly ordinary retired man who had never been told that his banking behavior, accumulated over 34 years of doing the right thing, had created exactly the kind of pattern the compliance software was designed to flag. Gary made 4 changes. He redistributed his savings across 2 institutions, so no single account held more than $200,000. He opened a term deposit at a regional bank, paying 4.2%, nearly double what his major bank had been paying on his savings account. He created a simple transaction log that he updates whenever he moves more than $5,000. And he pre-notified his bank before his next significant withdrawal, his son's vehicle purchase follow-up, and asked them to note the purpose in his file. His next large transaction cleared in 45 minutes. No back office, no manager, no questions. He told me later that the thing that surprised him most was not the relief. It was the anger. Not at the bank, not at AUSTRAC, at the gap. The gap between rules that had existed for nearly 20 years and a retired civil engineer from Toowoomba who had spent 34 years as a loyal customer of the same institution and had never once been told in plain language, "Ho." That gap is not an accident. It is not a conspiracy. It is the natural consequence of a regulatory system designed for compliance purposes, not for comprehension. A system that is accurate in its documentation and invisible in its communication. The rules are public. The legislation is online. The AUSTRAC guidance notes are published. But published regulation and plain language explanation are 2 completely different things. Somewhere right now there is another Gary. He is 64 or 68 or 72. He has spent decades at the same bank. He has saved carefully and lived within his means and never once thought about the words Suspicious Matter Report or Threshold Transaction Report or AML-CTF Act. He is planning to help a family member, buy something significant, or move money he has every right to move. And his bank's compliance software is going to flag it. Not because he is a criminal, because he is an ordinary Australian who was never told how the system watching him actually works. You now know how it works. Share this video with one person you know who is over 55 and keeps significant savings in a single account at a major Australian bank. One conversation, one afternoon of simple account restructuring. The difference between Gary's first experience and his second experience was not income, intelligence, or luck. It was information that arrived before the transaction instead of after it. The system is indifferent. It monitors what it is required to monitor, reports what it is required to report, and protects the money of the people who understood the rules from those who did not. The rules have not changed. Only whether you know them has. This is Mitchell Levi. I will see you in the next one.